Good morning, everyone. Welcome to TSAM Digital. My name is Anam Khan. I'm the head of content here at Vox on Media. And joined by me today, I have Maurits. Maurits is the business developer at Ortec Finance. Hello, Maurits. How are you?
Hi, Anam. Yeah, I'm doing very fine. Thank you very much. Yeah, very much look forward to this interview, to be honest.
Brilliant, brilliant. Thank you very much, Maurits, for joining us. To kick things off, can you please provide a bit background about Ortec Finance and about yourself?
Yeah, sure. Ortec Finance is a company that was founded in 1981 by a few PhD students at the Erasmus University who basically were trying to find new applications for operations research or optimization type of techniques. And slowly but gradually rolled into the financial world and trying to help pension plans or asset owners, perhaps more in general, optimize their investment decisions. In the years after that, we grow into a significant business in the Netherlands, where we were helping pension plans with their strategic asset allocation, but also started other ventures like, for instance, performance measurement and attribution, the topic we'll touch upon today. And slowly but gradually, I think that also brought us to the mission that we have today, which is really about helping people make complex investment decisions. And we do that by a combination of both technology as well as advisory services. I think we're still very much an innovative company. I think if you look at our solutions, they typically always have a bit of a different angle than what you see in the market due to those type of innovations where, for instance, we're quite active these days in the field of ESG or climate risk in more specifically, and trying to really incorporate that as a risk factor that you want to take into account for investment decision making. Me personally, I started with Ortec, I think some 12 years ago, just during the financial crisis. It was an interesting period to start with. Helping a lot of pension plans deal with the fallout, which I think immediately also gave us quite a lot of interesting new insights of where we wanted to go with our models, but also our advisory services. And then after a few years, I decided to join our London office, where I started focusing a bit more on the technology side of things and helping our clients using our ALM models, but also gradually moving into the area of performance measurement and attribution, where basically we don't only help our clients look forward and deal with the unknown, but we also want to get as much as information out of experience, and hence we use performance measurement and attribution to try and get a better feeling of where the investment corporations add value in the whole process. These days I'm responsible for business development for Europe for our performance measurement and attribution solution.
Brilliant. Thank you very much for that. Moving on to my next question. What is currently top of the minds of your clients and prospects?
I think it's quite a dynamic environment. We have clients all over the world in different countries, but also in different sections, like asset owners, like the pension funds I managed earlier, but we also serve asset managers and some sovereign wealth funds. I think they all have their own unique challenges, but I think if you look at it from a broader perspective, I think there's three items I think I would want to highlight. On one hand, I think operational efficiency is a very important one. The other one is dealing with ESG and climate risk more specifically. Third, I think there's also quite a lot of emphasis on trying to find out where the added value lies. And I think that's very specifically, of course, for performance attribution, an important topic. I think from an asset manager perspective, how do you add value? How do you create alpha? Where does it come from? But also for pension funds, for instance, and the long investment decision process they typically have in place. So which are the decisions that really add value and which ones are not?
Mm-hmm. Mm-hmm. And you mentioned about ESG, that it's one of the topics on the minds of your clients. What exactly are you seeing in that area?
Well, I think first of all, ESG is gaining a lot of attention. I think all over the place. I think at asset owners, at asset managers. I think it's definitely on everyone's agenda, which I definitely think is a very good thing. Um, what we see there is different types of developments, I have to say. I think on the one hand, you see that there's a lot of new data flowing into the market through all kinds of new channels, things like ESG ratings, carbon footprint. There's a vast universe of new data getting available to our clients. I think everybody has interest in that data, but at the same time, not everybody is completely sure yet how to use that data to actually come to a certain policy that would be in line with their own views on these topics. And just in the ESG part itself, the different pillars of environmental, social, and governance. I think there's still a lot of asset owners that are still struggling how they want to define a policy with each of those pillars. I think what we try to do, which is slightly different also than what you see currently, is with all this data flowing into the market, there's, I think, a strong emphasis on this bottom-up type of analysis, using that data to make decisions within a portfolio. What we try to do is, first of all, focus a bit more on one of the three pillars. So we decided to focus on climate risk foremost. And second of all, we've really decided to focus to come up with more of a top-down type of approach, where I think if you look at a large set of our clients are asset owners like pension funds and insurance companies, they typically start at the very top on a strategic level. What should be my strategic asset allocation? What is the ability to reach my objective, my strategic level of risk? Before they actually started to make all kinds of decisions to slowly but gradually move into the mandate type of level, portfolio level, if you may. What we've been trying to do is come up with a methodology that allows you already in the forward-looking strategic risk analysis take into account your exposure to climate risk, to say. On the other hand, I think on the performance part, we also have a clear challenge cut out for us. I think there's already due to that vast amount of data being available this data, there's already a tremendous amount of analysis that you can already do to see the added value of ESG. But at the same time, I think given that there's so many different alternatives how to actually implement the policy, you also need a lot of different types of analysis. And I think what we're trying to do, or at least see as the challenge, is to come up with an attribution type of framework that can incorporate all these different policies, aggregate that on a top level, and then really show what the added value of this ESG policy is also at the highest level.
Mm-hmm, mm-hmm. And you also mentioned that clients are focused on add value to the investment process. Could you elaborate that a little bit more?
Sure. So I think, basically since I started during this financial crisis, ever since, of course, returns, especially in fixed income markets, have been low due to quantitative easing. Hence people started looking for, on the one hand, alternative ways to make returns. On the other hand, of course, with returns being lower, they also started focusing more on costs. I think what you now see, maybe from different perspectives, but let's start with asset management first, for instance. We see that for asset managers, it's increasingly important to showcase the added value they bring to a certain mandate or portfolio. With the rise of ETF type of products, which are passive, very low cost, and I think that cost level is ever decreasing. It's more and more important for asset managers to show their added value. So where do they create alpha in that sense? Also for more complex products. If you look at multi-asset products that incorporate different asset classes, I think if you look at the performance attribution part of it, things already get a bit more complex because you need to have a multi-asset model that is able to deal with all these different type of asset classes that often also come with different attribution models. This focus on this added value, I think, is a challenge for asset managers. But one, of course, that we try to help them with through our performance software.
Mm-hmm. And how do you approach this? How do you help asset managers deal with this challenge?
Well, I think let's take, for instance, a multi-asset fund. I think what we've been doing on the one hand is originally when we started our performance measurement attribution solution, we really focused on pension funds, so the asset owner industry, to showcase the added value of their entire investment decision process. So they start with a strategic asset allocation, then they may take a number of tactical allocation decisions, then they might include a currency overlay or a liability hedge overlay. They might incorporate a couple of exclusion policies, for instance, for ESG type of policies. And basically what we've been doing for these asset owners is come up with a performance approach or a performance system that on the one hand can really follow the entire investment decision process and all the decisions being made, and attribute value to each of those decisions, working your way from the very top. So how, for instance, are my strategic asset allocation, how is that performing against my liabilities? And then as a next step, what's then the added value of these tactical decisions or the added value of my currency overlay? And well, all of these decisions we try to isolate and show the added value. And I think with now also the asset management market providing more complex products, I think our model in that sense is a very good way to help them also explain the added value in their investment processes, where the difference between asset managers and asset owners is getting smaller due to the more complex products they offer these days.
Mm-hmm. And sorry, go on.
Well, another good example for that, for instance, is if you look at the rise of fiduciary management. I think it comes under different names: fiduciary management, delegated investing, outsourced CIO type of services. I think what you basically see there is that the asset managers just takes a position that is very similar to a pension fund itself. So they just take control over the entire investment process, and especially for those type of applications, it's very hard to, if let's say you're a pension fund and you hire one of these managers, to determine whether that manager is doing well, because he's investing your specific pool of assets, but also on the premises that he's looking after your strategic objective and taking into account your risk appetite. So in that sense, you can't give him a plain vanilla type of benchmark, because it's so tailored on your specific situation. I think especially for these type of situations, again, this investment decision type of attribution approach is very useful.
We're close to the end of the interview. My last question will be around technology. What are you seeing, and what are your focuses for the coming years in terms of technology development?
I think recently we've gone through quite a lot of developments in our own solution, all based on the aim of helping our clients get a quicker and better access to attribution models. So we've been really focusing on the user interface, trying to make it a smoother experience, but also allowing our clients to, I think, with a smaller team, come up with a larger number of more complex analysis. It's a bit of a situation where things get more complex, but at the same time, the pressure on performance teams to deliver more with less resources is also quite big. So we've really put a lot of emphasis on helping our clients guide through this user interface and the configuration of the solution itself. We've been focusing on automation, as well as interfacing with the API and ETL type of techniques. I think what we're looking for now in the main challenge is, I think performance teams not only need to provide more and more complex analysis, but also need to provide them often on very short notice. So what we've been doing in the last couple of months, and basically is our roadmap for the upcoming period, is trying to find a better balance between the approach that we currently have, which we call performance book of records, and providing the ability to also come up with ad hoc type of analysis. So I think a performance book of records is really a way where you do overnight runs, do all the analytics, store that in a database, and that's then immediately available for the organization. Where we see with the more frequent and short notice type of requests that the performance teams are receiving, we're now also focusing on finding a bit more of a balance where on the one hand we still provide access to this performance book of record, but at the same time also allow our performance clients to incorporate new type of analysis on very short notice. Just hit the button, get the result, look at it, check it, send it to your client, and if they're happy, for instance, allows you to promote it to your performance book of record type of daily overnight runs. I think for us that's for the upcoming year definitely the main objective that we want to achieve in the area of our technology development.
Brilliant. Thank you very much, Maurits, for this insightful discussion. Really appreciate it. Hopefully our audience have enjoyed the discussion as well. Thank you very much for joining us.
Yeah, thank you very much as well, Anam, for the interview. Much enjoyed it. Thanks.